Ladies and gentlemen, for those who might know, I've started on a quest to create a powerful $20,000 a month retirement income. And my search for this $20,000 a month income has begun to shed some light. Now, I will share with you bits by bit over a long series of videos, and some of it might require you to watch some of my live stream, but today I will share with you a major breakthrough thinking. Let's watch on, shall we? So for many of you who might know, I have started on this quest, and the inspiration of it, of course, started from a lesson that I had with Mr. So Chin Hing, my financial mentor of 20 years. And all the while, my life has been racing towards accumulating a huge retirement fund by age of 65. And that's why we started the 1 in 65 movement, which has gradually evolved to bigger numbers. But I've not yet answered the question, what happens after 65? And this is where I've started a quest. I've talked a lot about CPF Life. I've pushed quite a lot of the boundaries. I even got some secret hacks that I have, which I share in my private courses. But right now, I'm going to go beyond CPF Life to take a look at what can be done beyond CPF. And this is where I thought of a very interesting discovery. And of course, a lot of it could never have been discovered if I don't have the power of artificial intelligence, which I use it heavily in finance analysis now. So today I'm going to turn investments into lifelong income with self-created cash-based annuity. And let me explain what on earth is this about. Why does this matter is because a lot of us need consistent income of various form. And of course, CPF Life will be an anchor to that. But a lot of us still have some cash and some equities in our portfolio. And a lot of people like to buy dividend stocks, which is something I am very against. And the challenge right now is that what do we do with all this non-CPF wealth that we have? And a lot of people said, no, Mr. Lu, no, I can put them in the property whatsoever. Well, the truth is, unless you rent out your only house you have that maybe stay in JB or stay with your children, your house itself, it's very difficult to be monetized unless you got two or more houses. And nowadays, because of ABSD, it's kind of difficult to monetize beyond one house as well. So property now, it's kind of difficult to move to income reliable stream. So therefore, right now, it becomes a very important drive for me to drive more income for more people. Now, there is a fundamental difference between CPF Life versus do-it-yourself income or annuity. Well, CPF Life is government guaranteed and it has got a lifelong longevity protection, meaning that, whatever age you live to, you will continue to pay for you. And of course, all these are work into the mathematics of it. We can't do that with our own self-created one, but we could do something, right, to supplement it. I still say again, your CPF Life must be your firm foundation. And this is where I also share with everybody before 65, we always form a financial safety net with CPF using a special account, a MediSave account. But post 65, your CPF Life will now take over as your firm foundation. And on top of that, then we replicate now possibly with global equities. Now, the self-made annuity concept that I've designed takes a look at number one, you have a lump sum, okay, of a sizable amount that to be put into a globally diversified portfolio. And here I don't want to be too prescriptive. Examples of such portfolio could be a mix of S&P 500, MSCI World Index, Dimensional Fund, NASDAQ, or whatever, right? I'm here not telling you what to invest in, but these are the potential funds that you could examine. Always check with your financial advisor. Nowadays, I don't want to be too prescriptive, okay? And let's say we target a return rate of between 5 to 8%. Now, 5% is on the low side, 8% is on a reasonable side, but I want to be more conservative. And this self-made annuity basically says, if I were to live to 90 years old, how much can I draw out under the assumption of different lump sum I put in under different interest rates or return rates I can get? Let me explain this with some more numbers. So this concept I did not develop myself. It comes from a Singapore net investment return contribution model, where the Singapore government, through the investment vehicle of GIC, MES, and Temasek, they manage a lot of national reserves. And what they do is that the long-term return rates, they will take out 50% of it, okay? And they use this to fund our national budget. And it's a huge number, and it supports roughly about 25% of our national budget reliably. Now, take note, it is what we call a long-term return, meaning that even in years where there are negative return, they will still draw out 50% of the long-term return. Example, in 2008 global financial crisis, the market went negative across the world. Any stock market they put in all will turn negative. But the NIRC response is to still draw out based on what we think is a long-term return. I don't exactly know. It's probably maybe a 7, 6, 8%, and they draw out 50% of that. So the key principle is that it's based on long-term expected return, not based on annual swing. So this year high, you take out more. This year low, you take out less, that kind of thing. No. So it's projected, that if the long-term return rates are about 8%, okay, they'll take out half of it. So I borrow this concept and says that what if I put in, let's say, $100,000, $200,000, $1 million, and I look at the long-term return rate of this fund and I draw out, okay, based on that concept. Now, I would, in this case, ignore volatility, and I need to say that through my simulations, I found out that if you put a small amount, the return rate every year may be subjected to more volatility as contrast to, let's say, your base is bigger. If you put in $500,000, $1 million, then your draw will be pretty stable and consistent. I won't bore you the details. There are some very sophisticated science behind this. But I just want to say that, this is based on real annuity formulas. And basically, I'm going to run through you some numbers right now. We'll start with something very high and promising. If you have $1 million and you project a return rate of 8%, now a rate 8% will probably require S&P 500 or equivalent, and to be held over a long period of time. So if the 8% will be drawn down across 12 months, and you assume yourself retiring at 70 years old all the way to live until 90 years old, then your monthly payout should be around $8,000. That's pretty strong. Now, if we assume a more conservative approach, you put in a $1 million at 5% return, then the monthly payout instead of 8,000 will be 6,500, right? So 5% is pretty safe, 8% kind of pushing the upper limit. But remember, this requires $1 million at 5% return, starting age of withdrawal 70%, assuming you live to 90 years old. Now, this table gives you the full summary of it. Now, a lot of you are going to say, wow, 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 wow. What I'll do is that in tonight's live stream, I'll go in deep detail. But right now, let me give you the high levels. So if you were to assume you put in $250,000 at the lower limit of 5%, you get about 1,004. At a higher limit of 8%, you get about 1,009. So 250,000 give you about 1,005 to 1,009, okay? But if you go to the higher limit, okay, you will get probably about at 5% return. If you put in $1 million, you get about $5,800 all the way to $7,500 if you have 8%. So basically, the range that you get, okay, differs quite a lot based on at what age you draw out or start drawing out, what's your return rate, and also what is your longevity. So I would say that this approach is pretty robust. You put in a sum of money into a globally diversified index, draw out based on what you think the return rates will be. I think a safe rate will be somewhere around 6% or 7%, okay? And if at 6 or 7%, if you put in $500,000, you will get roughly about $3,000, okay, or 3,005. And if you could put in $1 million, that you can go as high as 7,005. Now, if you stretch your retirement to retire at 70, that means you continue to work until 70. It's not unthinkable, okay? then your real returns, if you put in $250,000 at 5% is about $1,600, and it could go to $2,000 at 8%. Now, if you stretch it all the way to invest one solid $1 million, which is very difficult, I understand, but one solid $1 million goes into a globally diversified index that can give you 5% return, then your monthly income will be around 6,500 all the way to 6,000 to $8,200 if it's 8%. So you kind of know where the numbers are. Okay, if you are keen tonight, I can walk through with you some of the other details as well, and can you ask me some questions. So in short, if you retire at 65, you have a longer runway, so the amount of money you get every month is lesser. It's actually similar to CPF Life. Okay, so you have to cater for 25 years of income with moderate monthly income. In the event you want to retire at 70 years old, you will get higher payout every month, and this monthly income will go up even higher the more money you put into it, and the more returns the fund will give you. So in short, the age comparison benefit really is at 65 years old, withdrawal, or 65 years old, retirement, lower monthly pay but longer security. At 70 years old, you have higher monthly pay, shorter time horizon. So the key advantage of this approach is that it actually could supplement your CPF Life. Your CPF Life, while it's government guaranteed, the returns are not so exciting. And this one, you could get a higher return. And it's very scalable. You can put in any amount. You don't have caps that are assumed by CPF Life. And you could, in some sense, anytime you want to draw yourself, you can draw yourself. And this would be a perfect complement to your CPF Life. Someone might say, Mr. Lu, why don't we just take all our money out, whatever that we can, instead of topping up to ERS, you just take out whatever extra you have, just keep it FRS and do this. Well, you can, except that this one, there's no guarantee, right? There's no longevity guarantee. I like a financial safety net first. On top of that, I take some risk, right? Not a lot of risk, but some risk. I think that approach of a two-tier approach is actually safer. Now, what are some of the important risks to consider? There is no guarantee like government annuities, right? So that kind of protection is actually quite good. Now, supposing one day you invest in S&P 500 and for any reason, right, the S&P 500 completely collapse, right, drop by 60-70% and never recover, then that's going to be a serious problem, right? It never happened over the last 100 over years, but sway at this time it happened, then I don't know what to say. It can happen, chances is low, but it can happen. And of course, there are risks as well. If you cannot control your emotions and you play with stocks and shares, you go in out all this, then I think you're gonna ruin your return rates. And of course, in this case, there's no longevity protection. You live beyond 90 years old, the fund completely run out. Okay, unlike the CPF Life. So that's why I think a complement approach, okay, a complementary approach between CPF Life and this approach is better. So this is the ultimate quest I have to create income streams that are way above CPF Life numbers to 10, 15, even $20,000 income a month. That require a lot of constructive thinking, a lot of innovation involved, and of course, powered by AI, I could actually work this out a lot more easier. So right now, I've cracked some parts of the equation. I'm looking at more and more. And as I discover more, I'd like to share with you. And I welcome all the criticism as well so that we can finesse this properly. As I previously developed the 1865 strategy that benefit the whole of Singapore. Right now, I'm in the quest to develop a powerful income post-retirement. I haven't given it a sexy name yet. I might, but once I design the strategy, then maybe you can think about naming terminology. So engineering our financial future post-retirement is something that's extremely important, just as how Singapore government uses our financial reserve for a disciplined long-term withdrawal. We too can take some lessons from there and engineer our own retirement income to supplement the CPF Life. So for those people who are yet to retire, quickly build as much capital as possible. Okay, you could use the capital to do a range of wonders that can build your post retirement income. And there's a lot of discipline, there's a lot of financial wisdom involved. But the end goal of it is that I wish everybody could benefit from this tremendously. Let me know your feedback. I'm happy to hear from you. Thanks for watching, and we'll discuss this in detail tonight in our live stream. Bye bye.